getting back to kind of the general structures of insurance companies, the first thing to just, again, point out is that insurance companies are basically financial intermediaries. Okay? They're businesses, they're like banks in a way. They collect money, they pay it out. All right? They bring in money via premiums, and they pay it out in terms of reimbursements. So that's really their extent. Now, they take their profits out, they pay their employees, but they're not making policy, they're not ever actually paying. All they're doing is just, holding that money in the pot and then paying out when they need to. Now, when it comes to within insurance, there's a ton of different types that are out there. And this, with insurance, more than anything, you get what you pay for. Okay? You get what you pay for. And with that, keeping that in mind, it's the better plan you have, the more you're going to pay for it. And so basically, when you get a plan, there's more or less risk depending on what type of plan you have. And so, for example, some plans have it to where they'll pay your deductible, which is the amount you pay before the insurance kicks in, could be very low. Right? At that case, you're eliminating a lot of risk of those high expenses. Whereas other insurances have high deductibles before they start kicking in, and so there's a lot of risk on you there as far as if you get sick or injured. Now, when it comes to insurance, every plan has different rules and regulations with it, and included that is how they actually pay. So the provider, how they get paid by the arrangement that the providers have, a lot of times the insurance companies dealing with how the insurance company has to pay them, or how they charge and how they bill. There's some different ways. Now, we're going to address these more when we get into physicians and hospitals, but just kind of a couple ways that physicians handle their billing. One way is by fee for service, which is literally a fee for a service. So every time they do service X, the insurance company pays them $100. Whenever they do service Y, the insurance company pays them $500. So it's all set up there. Bundled is a set of services that are grouped together for one price. So probably a good example for this is if you go to the doctor, a lot of things that the doctor would do to check out, what's wrong with you. For example, it's not, he doesn't charge you for blood pressure and looking in your ears and all the other stuff, right? Kind of all those are bundled together in one price for the visit. Capitation is bigger in HMO plans, health maintenance organization plans. And what capitation is, it's a set payment per enrolled employee per month. And we're going to talk more about this. But basically what happens with a lot of these plans is, especially with HMO plans, the insurance company, they'll have, all right, if a doctor takes and has a patient from that insurance company, the insurance company will pay them X dollars of every month, all right, regardless of the number of times they go there. Carve out is when services are outsourced basically to other. So for example, most doctors' offices don't do their own blood work, they outsource it. Administered is prices that are set in advance by the government. And negotiated payments are prices that are worked out between the insurance company and the providers. Now, with the insurance companies, there's a term called a medical loss ratio, and this is important. This is a nonprofit, it's the nonprofit or administrative percent of cost Right? So basically, it's all the money, it's the percentage of all premiums that they collect that actually go towards patient care. So let's look at an example. So over here, we have a hypothetical insurance company where their money goes. So they find that 41% of all the money they pay out goes to physicians and outpatient. 31% is for inpatient. 7% outside referrals, 3% emergency, and 13% for administrative. Now that leaves 5% for profits. So keeping in mind that the medical loss ratio is the percentage of premiums that go towards care, when you look at that, let's see, physician and outpatient towards care, inpatient towards care, outside referrals towards care, and emergency towards care. Now, administrative is money they keep in-house to pay their employees and upkeep and paying the bills. And then profit also does go towards care. So here in this example, the medical loss ratio was 82%. One of the provisions in the Affordable Care Act, right, and this was an effort to stop and to basically help cut back on insurance companies from overcharging. Part of the Affordable Care Act was, I don't think it was in these exact words, but the medical loss ratio had to be at least 85% for most insurance companies. At least 85. So they said basically that insurance companies need to pay out at least 85% of everything they bring in for patient care. Claim processing, getting a medical bill paid is a long and a complicated process, but it's also very profitable because of the complexity. They have people who work in doctor's office, larger doctor's office at least, who deal just with that. So it's a process. It goes back and forth, and there's really a lot that goes into it. Now, the underwriting. So insurance companies need to set their rates, and in the long run, any increases in premiums must cover any increases in costs that are happening. So if costs go up, they have to increase their premiums, otherwise they're going to start to lose money. In the short run, however, you see some fluctuation. And so if we look at an example here, this shows from 88 to 2008. And so now keep in mind, these are all increases. So this is not saying that insurance premiums are going down or up, and same in medical costs. Right? It's just saying that they're increasing at different paces. So if we look here, we can see that from, this is 88 through 94, insurance premiums are going up at faster paces than medical costs. So during this process, the insurance companies' profits are expanding. Now, they still have to be competitive with others, and they can't get too out of hand with that. So what you see then is they have to slow down those increases to kind of make up for it. Now, during this period in here, 94 through 98, 99, costs are going up faster than premiums. And so when that happens, profits are going down. They're shrinking. And so, again, there is a correction. So this process is consistently going through, and profits increase and decrease because of this. Okay. Insurance really breaks the link directly between getting care and what you're paying for. Right? So because we talked about this idea of how we're paying less and less percentage-wise out of pocket. And so because of that, that gap is getting between what is being paid and what we are paying is getting larger and larger. And so you're seeing, what's been seen is a large increase in costs because of that. We talked about the moral hazard issues without the corresponding increases in the quality. So that's a pretty big issue. But as far as the insurance company, the contracting, the payments methods, it's just kind of an broad overview of it.